Meta Platforms Inc., ticker symbol Meta, previously known as Facebook, is currently trading at $521.12 a share. If we look at the stock over the last year, it is up about 4.25%, but it was previously trading at its all-time highs at $736 and has had a 30% decrease from that time. What we're going to be doing is looking at the most recent earnings and then taking it to my automated stock valuation spreadsheet to see if Meta is a buy or a sell using the discounted free cash flow model, comparable company model, dividend discount model, and Ben Graham formula for intrinsic value. So let's just put in the ticker Meta, and this will load up all the latest company financial data. If you're interested, check in my sheet, check my Patreon, it's the $4 tier. So, as I said before, $521 a share, market cap of 1.3 trillion, PE ratio of 21.6, which is a lot lower than the market average, the S&P average, which is just below 27. So, is this a buying opportunity? Earnings per share, $24.13, a beta of 1.28, meaning it's more volatile than the market, and analysts have it as a massive buy at nearly $740 a share, which is what it was pretty much in the middle of February before this most recent sell-off, the market downturn. Dividend, yes it does, it pays a dividend 0.39%, meaning you'll get paid $2.04 a share. Now it's a very safe dividend, 4.5 billion, which is 7% of the net income and 8% of the free cash flow. Buy before the 14th of June if you want to get paid. So let's have a look at revenues. Ignore the trailing 12 months, but you can see it's all-time highs for Meta, 164 billion, or 164.5 billion. Now if we do go to the earnings, which is here, this is the 3 months ended and 12 months ended on the revenue, 40 billion up to 48.3, up 21%, and on the full year 134.9 up to 164. Just some other things here. Daily active people, 3.35 billion, which is a 5% increase. Ad impressions up, average price per ad up, revenue is up, CapEx is up, and you can see headcount is increasing actually, which is surprising. But yeah, they do cuts quite often, but they are hiring people. Then we have, well, let me just scroll a little bit further down here. Where is it? We have the different segments. So Meta's are advertising, which is obviously the advertising revenue. This is their main driver. Other revenue, and then family of apps, which is digital advertising specifically on Facebook, Instagram, Messenger, and WhatsApp, and then Reality Labs, which is the VR and AR, virtual reality, augmented reality. So in terms of advertising, obviously the big chunk of the revenue, 38.7 to 46.7, and then on the year 131 to 160, split between the family of apps and Reality Labs. 133 and 1.8 to 162 and 2.1, and the sort of this is the income or loss. Obviously the family of apps up massively, 62.8 and 67.1, whereas Reality Labs is losing the money at the minute, 16.1 to 17.7. But obviously the revenue side on the advertising is what's keeping Meta high. Now, are they generating more profit? Yes, they are. All-time highs, 62.32 billion, massive profit. Free cash flow, massive free cash flow as well, 54.07. And if we look at operating cash flow versus CapEx, as said before, they are spending a lot of CapEx, but operating cash flow is smashing all-time highs. And that's why free cash flow is so high. Shares outstanding, they are now buying back the shares they have been for the last few years, rewarding shareholders. So let's have a look at the discounted free cash flow model. This is a way of buying stocks, looking at their future free cash flows and discounting to today's value. And let's see what it, my mistake. Let's see what it gives us based on some averages. $450 a share, and this is with a high weighted average cost of capital. If we bring that down to the usual amount, which is about 8.5%, it would be about 560, but we'll keep it currently where it is, which was the current weighted average cost of capital. We're expecting 183 and 204 billion in the coming years. Do analysts agree with those sort of revenue estimates? We're a little bit more bearish actually, so we'll increase those just a smidge. We'll do about 14%, brings us to 488. Net income margins, I'd say they're increasing their margins. Let's take an average of these last few years. 39%, we'll even bring this to 40. Puts it at 553. So, yep, and net income to free cash flow, I mean, this is the last year. pretty much close. So discount free cash flow model has it as a buy, which is rare to see, or was rare to see in a company like Meta, these big tech giants. But Facebook or Meta is generating lots and lots of free cash flow. Dividend discount model, we can't use it yet, but in a few years we will be able to do as they'll increase their dividends. Currently done a 5% increase, so that's good to see. Ben Graham formula for intrinsic value. I don't think Ben Graham will like it. He doesn't like many stocks at the minute due to the high bond yields or high inflation environment. 14.66. So it puts it at $460 a share. Obviously not a buy, but getting there. So if we weren't in such a high interest rate environment, then obviously it would be more of a buy. But anyway, quite interesting to see. So finally, let's have a look at the comparable company model. This is a way of valuing stocks. Look at the competitors. We'll look at revenue, the growth rates, EBITDA, net income, profit margins, price to sales, price to book, PEG, EV to revenue, EV to EBITDA, PE, and forward PE. So the ones that are closest to it, we'll go with Google, which is obviously Google, Microsoft, and Apple. These are sort of the tech giants. If I open up the S&P 500 top constituents, by weight, it goes Apple, Microsoft, Nvidia, Amazon, then Meta. So we can actually switch some of these out, but let's let these load first. Come on, Google, why are you being so slow? Oh, actually, what I'll do just in the meantime, let's put Microsoft here, we'll put Apple here, and then we will put, finally, we will go with Google here, just in case it doesn't load, but it should be fine. So in terms of enterprise value, Meta is the smallest with 1.3 trillion. As I said before, Apple and Microsoft are the highest with 3 and 2.8. Google is not loading for some reason, so we'll just compare the two companies here. Well, actually, we'll just leave it as it is for now. Revenue growth rate, Meta is the highest. 1 year growth rate is the highest. Lowest revenue, obviously. EV to EBITDA, second lowest. Net income, lowest, but margins is the highest, 38% compared to Microsoft and Apple's 35 and 24. Let me just load up Amazon in the meantime, see that loads. Price to sales, it is the lowest, or one of the lowest. Price to book, it is the lowest. PEG, ideally you want this under 1, it's the closest, 1.07. EV to revenue, middle of the road. EV to EBITDA is the lowest, PE is the lowest, and forward PE is the lowest. So compared to Microsoft, Apple, and Amazon, it is a buy. 580 is the price. Wish I could get Google up here. I don't know why Google's being so strange. Ticker symbol, we'll go Google, the other ticker. See if that loads. These are the Class A shares. Problem is with it's interesting because it's actually Google Finance, a lot of the stuff I'm using here. And they can't even load their own ticker, which is very, very interesting. Maybe they don't like what it's valued at. Maybe they're hiding it. Okay, fine. So yeah, it's not loading. Now if we were to just compare against Microsoft and Apple, $600 a share. So Meta does look undervalued to its competitors, which is quite interesting to see. Right guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. Check out my Patreon, and I'll catch you guys next time.